You don't need 20% returns. You need to stop acting like you do. Most people screw this up because they don't like the sound of 7%. It's not sexy, it's not fast, it doesn't get clicks. But 7% and done quietly, done consistently, done with discipline, that will bury 90% of the noise you hear online. I've seen the wreckage firsthand. Friends, colleagues, smart people with high-paying jobs, nice homes, respectable titles. They get to age 52, 55, even 60, and realize they're way behind. And then panic sets in. I need to double my money fast. So they swing for the fences, options, crypto, private deals they don't understand. They call it being aggressive or catching up. But here's the truth. They're gambling. And they're gambling at the worst possible moment. You want a hard truth? A boring 7% return, held over 20 years, with no blow-ups, no drama, no sudden moves, quietly turns $250,000 into over $1 million. No need to find the next Tesla. No need to time the market or guess the next Fed move. No need to outsmart the crowd. All you need is to not blow yourself up. The math works, if you let it. But the problem is, people don't let it. They sabotage it because 7% doesn't make you feel smart. It doesn't make for a viral story. It doesn't feel like catching up, so they chase excitement. They chase brilliance. They chase someone else's path, someone else's luck, and it blows up. This is where I tell you. If you're over 50, this isn't a game you can restart. You don't have decades to rebuild. You don't get to make 3 more mistakes and shrug it off. You've got one last stretch of the marathon. And the finish line isn't rich, it's solvent, it's sane, it's quiet. That's what this plan is about. The 7% plan isn't flashy, it's fatalistic. It's for the investor who knows they can't afford another mistake and who understands that survival is the real secret to wealth. Now let's look at why that matters more than ever and why it's still not too late. If you're over 50, maybe even over 60, you already know the clock isn't in your favor, not because you're lazy, not because you weren't trying, but because life got in the way. Kids, bills, maybe a divorce, maybe some medical curveballs, maybe you trusted the wrong person with your money or with your time, and now you're staring at the numbers. You've run the calculators, you've looked at your savings, you've done the how much do I need to retire quiz, and you're thinking, how the hell am I supposed to make this work? Let me be blunt with you. You're not starting from scratch, but you also don't have time to rebuild from zero if things go sideways. There's no reset button at 58. There's no back to the drawing board at 64. There's no miracle comeback play at 67. This is why the rules are different for you. Not worse, just different. Young people can afford to be stupid. They've got time, energy, optionality, and more importantly, a margin for error. You don't. But here's the good news. You can still build something that lasts. You can still grow your wealth from here, modestly, methodically, meaningfully. You can still end up with freedom and dignity, but only if you stop pretending you're 35, only if you stop chasing the lottery, only if you stop trying to make up for 20 years and 24 months, because that desperation, that's how people blow up. Now I know what you're thinking. I've got $120,000, maybe $200,000 saved. Isn't that too small to matter? Not even close. I'll prove it later in this video. With math, not motivation, but first, I need you to understand the real stakes. If you mess this up, if you try to sprint your way out of a long race, you don't just lose money, you lose time, you lose confidence, you lose optionality. And in your 50s or 60s, those are the last things you can afford to lose. So this plan, this boring, quiet 7% plan, it's not just about making money, it's about protecting your second half. And I've seen, with my own eyes, what happens when people ignore this. Let me tell you 2 stories. One ends with disaster. The other ends with a quiet win no one celebrated, but they should have. His name was Carl, engineer, mid-level manager, lived in Phoenix. 2 kids, made good money, not flashy, but steady. At 55, he realized he'd only saved about $180,000. He panicked, started reading blogs, watching finance YouTubers half his age, listening to people shouting 10 times opportunities and next Amazon picks. He started believing he could make up for 2 decades of undersaving with 2 years of overachieving. He bought into tech funds he didn't understand, started trading options poorly. Then he went further, leveraged ETFs. He told himself, if I can just double this $180,000, I'll feel safe. The market didn't cooperate. 2022 wiped out 40% of his net worth. Then he sold in fear, not in strategy. Tried to time the bottom, got it wrong again. By the time I spoke to him, he was down to about $88,000. What's worse, his confidence was shattered. His trust in the system was gone. He felt like he'd failed his family. And the worst part, he didn't even fail because of some catastrophic event. He failed because he didn't respect the math. He let emotion and urgency override judgment. Carl didn't need 15% returns. He needed to stop hemorrhaging value with bad decisions, but by the time he realized that, the damage was done. It wasn't just money he lost, it was time he didn't have. Now let me tell you about someone else. Her name was Teresa, widowed at 53, never earned more than $65,000 in her life. When her husband passed, she had around $230,000 saved between his 401k and her modest IRA. Not nothing, but not enough to coast either. She didn't try to catch up, didn't start hunting for triple-digit returns, didn't let fear drive her strategy. She put the money into a boring, diversified index strategy, 60-40 allocation, some dividend payers, cash buffer, no leverage, no drama, no noise. She averaged just under 7% a year, some years better, some worse. But she never touched the principal in a panic, never pulled out during a downturn. Just let it run. Fast forward 20 years. She's 73. That $230,000 had quietly grown to over $880,000. She still lives in the same house, drives a used car. But she has something that Carl doesn't. Peace, control, dignity. No one writes blog posts about Teresa. She doesn't brag at cocktail parties, but she won because she understood that wealth isn't loud. It's disciplined. It's patient. And more than anything, it's protected. Now I'll show you why Carl and Teresa ended up in such different places, even though they started in the same ballpark. It wasn't IQ. It wasn't access. It wasn't luck. It was behavior. And more specifically, it was what they each refused to do. Let's walk through the most common mistakes that take people like Carl down and how to avoid every single one. Let's be clear about something up front. You don't need to be a genius to win with money, but you do have to stop doing dumb things. And I don't mean that as an insult. I mean it as a survival rule. Most people don't fail because of bad luck. They fail because of recurring stupidity, habits, behaviors, mindsets that quietly erode their future. So here's what I call the 7 deadly sins of late life investing. 1, chasing high returns. Too late. At 25, you can take wild swings. At 55, every swing you take has consequences you might not recover from. Yet I constantly see people in their late 50s pouring into risky growth stocks, crypto schemes, day trading rooms, thinking they can outpace time. You can't. At this stage, the goal is survival, not speed. Every dollar lost now costs you years, not months, of recovery too. Dismissing small gains as irrelevant. I only made 6% this year. That's nothing. Really? That nothing, if you let it roll, will double your money in 12 years, triple it in 18, quadruple in 24. But you won't see that if you keep interrupting the process just because it's not fast enough to impress your nephew. Small gains aren't small when you compound them. They're everything. 3, following loud advice from overconfident fools. If you're taking financial advice from someone yelling into a webcam, stop. Volume is not wisdom. Confidence is not competence. I've seen more portfolios destroyed by overconfident mentors than by market crashes. And here's the pattern. They win once. They get loud, you trust them. Then you follow them right off a cliff. At 25, that's a lesson. At 60, that's a disaster. 4, panicking during downturns. A market dip is not a reason to abandon ship, but when you've only got a 10 to 15 year horizon left, it feels like you don't have time to wait. So you sell at the bottom, you lock in the loss, and you kill the compounding engine. The truth? Most recoveries happen after people give up. You can't afford to be one of them. 5, overcomplicating the portfolio. If your investment strategy needs a PowerPoint to explain it, you've gone too far. Late-stage investors often fall into the trap of sophistication. They feel like basic index funds are too simple, so they add layers. Hedge this, tilt that, rebalance weekly. It's financial theater. It feels smart, but it rarely outperforms the basics. Keep it simple. Keep it boring. Keep it bulletproof. 6, neglecting basic math. If you don't know what 7% over 20 years does to your money, you're playing blindfolded. You don't need to know options, Greeks. You need to know compounding tables. You need to understand withdrawal rates, inflation erosion, sequence of returns risk. Most people spend more time planning vacations than they do learning this, and it shows. 7. Comparing yourself to others. This one's subtle, but deadly. You hear someone your age just sold a business. Your neighbor's kid is already retired at 33. A friend just 10x'd their crypto bag. And suddenly, your solid 6.5% return feels pathetic. So you throw away a working plan. Because it doesn't make you feel special, comparison breeds envy. Envy breeds risk. Risk kills portfolios. The antidote? Focus on your lane. Win your game. These aren't just mistakes, they're recurring financial diseases, and they're treatable, but only if you admit you've caught them. Now let's step out of the symptom zone and into the one rule that would have saved Carl and quietly turned Teresa into a millionaire. It's not flashy, but it's fundamental. If I could drill one rule into every investor's brain, especially if you're over 50, it would be this: 7% done right beats 20% done wrong every time, every decade, every portfolio. And yet, most people ignore it because the number sounds small. But small doesn't mean weak. Let me show you part A, the math. Let's say you're 55 years old. You've managed to save $250,000. You've got no pension and maybe 10 to 15 years before you start withdrawing. Now watch this. At 7% annual return, no extra contributions, that money grows to $492,000 by age 65. Leave it another 10 years. You're looking at $967,000 by age 75. No luck, no magic, just boring compounding. Now let's say you get excited and aim for 12% annual returns instead. But to chase that, you take on high volatility investments. Some work, some don't. You suffer a big drawdown in year 3, a 35% loss, and panic sell. Now you're down to $160,000. And emotionally, you're shot. Your average return might still look good on paper, but in practice, you never get the compounding tailwind. Why? Because you interrupted it. That's the tragedy most people never see coming. It's not about maximizing returns. It's about minimizing interruptions. 7% works because you can actually stick with it, because it protects your downside, because it avoids the fatal math of a major loss. Part B, the psychology. The human brain isn't built for compounding, it's built for drama, for stories, for comparison, for envy. That's why people jump out of good plans. 7% feels too slow, so you chase 30%, then get minus 40%. It's not your IQ that fails, it's your attention span, it's your ego. You see your friend post a $90,000 gain on Twitter. You see a YouTuber bragging about doubling their account, and suddenly your safe, boring plan feels like failure. But what you don't see, the friend never talks about his losses. The YouTuber is probably selling courses, not managing risk. Compounding requires humility, and humility doesn't get headlines, but it does build wealth. Part C, the philosophy. You're not here to impress anyone. You're not here to gamble. You're not here to catch up in one leap. You're here to finish the game standing up with your money, your health, and your sanity. And that means embracing a philosophy most people can't stomach. Boring is beautiful. If it's working, don't touch it. If it's growing, don't interrupt it. If it's simple, don't complicate it. That's not weakness. That's wisdom. Teresa understood this. She didn't chase brilliance. She honored the system Carl didn't. And you saw the result. Now let's get practical, because philosophy is nice, but you need a checklist. You need a compass. You need rules that you can actually follow, even when things get weird. Let me give you the real plan, the filters, rules, and habits that make 7% not just possible, but likely. Practical checklist. 10 rules for a boringly rich life. Let's turn the 7% philosophy into real-world action. If you want a chance to retire with dignity, not headlines, not drama, just quiet confidence, then follow these 10 rules, not 1 or 2, not when you feel like it, all of them, consistently. 1. Stop touching your portfolio. Every time you panic and move things around, you lose. The best investors are not the smartest. They're the ones who made fewer decisions. If it's working, leave it alone. 2. Hold cash for emergencies, not investments. Have 6 to 12 months of expenses in cash. Not for buying dips, not for trading opportunities. Cash is emotional insulation. It keeps you from touching your real investments during bad times. 3. Use low-cost index funds as your core. If you can't explain your holdings in 10 seconds, you don't own it. It owns you. Keep 80 to 90% of your portfolio in boring, diversified, low-fee index funds. S&P 500. Total market, maybe some international exposure. If it's complicated, it's probably killing your returns. 4. Limit yourself to one portfolio move per year. Yes, one. Force yourself to pause before acting. Most urgent decisions are mistakes in disguise. Review annually. Adjust slowly. Sleep on everything. 5. Automate everything you can. Your contributions, your rebalancing, your bills. Automate them. The more you automate, the less you feel the market. And the less you feel it, the less likely you are to mess it up. 6. Never take financial advice from people who sell hype. If they sell fear, excitement, or urgency, walk away. You need quiet, experienced voices, not entertainers, not influencers. 7. Anchor. All decisions to time horizon, not emotion. If you're 58 and your goal is to retire at 67, that's your map. Don't make 24-hour decisions for a 9-year game. Zoom out, always. 8. Prioritize downside protection over upside fantasy. A 30% gain feels good, but avoiding a 50% loss is what actually keeps you in the game. Never risk ruin for return. 9. Use sleep at night filters for every investment. Would you be okay holding it during a crash? Would you be fine not touching it for 5 years? If not, you shouldn't own it. Sleep well. That's your new benchmark. 10. Tell no one about your wins. The more you talk, the more you start to perform, and the more you perform, the more you start taking risks to maintain the illusion. Wealth is not a performance, it's a protection. Let it be invisible, let it be boring, let it be yours. These rules aren't trendy, but they're reliable. They're what Teresa followed and Carl ignored. They're what makes 7% feel like magic, even though it's just math. Next, we'll dismantle the myths keeping you stuck, because chances are there's a question rattling around in your head right now. Isn't it too late? Let's tackle that. And 4 more late starter myths head on. Let's face some of the most common myths that poison good decision making for late starters. Because it's not just bad advice that ruins portfolios. It's the false beliefs people carry silently you've probably heard, or even said some of these yourself. Let's tackle them one by one. Myth number 1, it's too late to start. This is the biggest lie holding people back. Listen, if you're 55 and you live another 30 years, you've got plenty of time for compounding to do its job. The key is to stop thinking in retirement age and start thinking in longevity math. You don't need to be rich by 65. You need to be solvent at 85. Big difference. If you can stack 10 to 15 years of disciplined investing at 6 to 7%, you'll be in a radically different place. Not because of brilliance, but because you started. Myth number 2, $250,000 is too small to matter. Let's do real math. $250,000 growing at 7% annually turns into $491,000 in 10 years, $967,000 in 20 years, $1.9 million in 30 years. Now you might say, but I won't live that long. Fair enough. But what if your spouse does? What if your health improves? What if you end up living into your 90s, like millions of people now do? Don't plan for a short life, plan for the one where you outlive your savings. Because running out of money is not just inconvenient, it's terrifying. Let your portfolio keep working, even after you retire. Myth number 3. Paying off debt comes first, always. Not always. High-interest consumer debt. Yes, that's an emergency, but low-interest debt, like a 3% mortgage or 2.9% car loan, that's a different story. If you've got a cash buffer, stable income, and a 7% investment strategy, it often makes more sense to invest than to accelerate low-yield debt payoff. Money is math. Don't let fear pretend to be discipline. Run the numbers, not your feelings. Myth number 4, you need a financial advisor to succeed. No, you don't. You need a system. You need rules. You need to stop interrupting your progress. That's it. Now, can an advisor help? Sure, but many charge 1% of your assets, which is a guaranteed drag on your returns. If you're paying 1% to someone who just shuffles funds around and tells you what you already know, you're losing money. You don't need a guru. You need discipline, and that's free if you choose it. Myth number 5, if the market crashes again, I'm doomed. Wrong mindset. You're only doomed if you panic. You're only doomed if you need to sell during the crash. That's why we build buffers. That's why we keep cash. Market crashes are not death sentences. They're part of the cycle. If you treat them like buying opportunities, or at least stay calm through them, they actually accelerate your long-term gains. It's the people who react emotionally who get punished. You're going to stay calm because you've already planned for it. And if you haven't yet, we'll fix that next. Let's speak directly to the hardest scenario, the person who's starting late, behind on savings, and scared. That might be you, and that's okay. As long as you don't lie to yourself about what comes next, let's talk to the viewer who feels late. You might be 58, 62, maybe even 67, and you're thinking, I've wasted too much time. I didn't start early enough. It's over. No, it's not over, but you have to stop lying to yourself about where you are, because what comes next isn't about optimizing returns. It's about prioritizing survival. Here's how to do that, with clarity, not panic. Acknowledge the starting line without shame. You can't fix what you won't face. Pull up the numbers. Look at your total investable assets, your monthly expenses, your debt. Be brutally honest. You're not here to impress anyone. You're here to solve your next chapter, and that starts by owning your reality, without shame, without excuses. Prioritize the big 3. If you're behind, your game plan must revolve around just 3 priorities. Debt reduction, especially high interest. Cash buffer, 6 to 12 months of expenses. Simple portfolio, low cost, boring, steady. Forget real estate flips. Forget angel investing. Forget catching up. If you nail these 3, you'll stabilize, and that's the first victory. Stop trying to win back lost time. You will never make up for lost decades by cramming in risky investments now. That's how people torch what little they've managed to save. Late starters must act like capital preservers, not capital conquerors. The name of the game is not blowing up. And that means saying no a lot. No to leverage, no to meme stocks, no to TikTok financial advice. You're not playing for applause. You're playing for freedom. Protect your energy and focus. At this stage, your attention is one of your most valuable assets. Don't waste it chasing charts, watching market tickers, or arguing online. Set your plan, automate what you can, and get back to living. Because being over 50 and in control of your money, even if it's not a big pile, is a kind of wealth most people never reach. Reframe your retirement vision. You might not retire at 60 with beachfront property and daily golf. So what? Can you work part-time at 67 instead of full-time at 75? Can you downsize and be mortgage-free instead of stretching for appearances? Can you remove financial anxiety from your final decades? That's real freedom. That's the win. Retirement is not a finish line. It's a lifestyle design challenge. And late starters still have a say in how it unfolds if they stop trying to sprint. Avoid hero moves. Trying to turn $50,000 into $500,000 in 5 years is not brave. It's desperation dressed up as optimism. If you want to be a hero, be the person who quietly follows a 6% plan for 12 years and ends up debt-free, solvent, and dignified. Because that story doesn't get told enough. But it's real, and it's yours, if you stop pretending the casino will save you. Now, let's zoom back out. Let's talk about culture. Let's talk about the noise you've been soaking in for years, the envy, the fear, the toxic influencers. And let's go deep into the philosophy behind the 7% plan, the worldview that protects your money, your time, and your soul. There's something you need to understand about wealth. It doesn't look like what they told you. It's not 6 cars. It's not screaming into a mic about your alpha. It's not quitting your job at 32 because you YOLO'd the right stock. Wealth, real wealth, looks like quiet. It looks like sleeping well. It looks like not checking the market every 5 minutes. It looks like being able to help your kids without needing their help, but no one sells that because peace doesn't go viral. You've been lied to by a culture that worships speed, comparison, and noise. Make it fast. Make it big. Make sure everyone sees it. That's the modern script, and it's killing people financially, especially older investors trying to catch up. If you're over 50, you've probably soaked in more financial noise in the past 5 years than your parents did in their entire lifetimes. It's everywhere. Podcasts, newsletters, Reddit, CNBC, TikTok, everyone screaming, everyone winning, no one explaining the consequences. And the cost isn't just money, it's mental clarity, it's decision fatigue, it's the erosion of your own judgment. Because when you hear 50 people yelling 50 different things, you forget how to listen to yourself. Let me tell you something about the people who actually end up wealthy, the ones who keep their wealth, not just flash it. They don't talk much. They're not exciting. They don't make big moves. They make the right small ones. They compound in silence. They say no to almost everything. They understand that every decision has a tail, and that managing risk is more important than chasing reward. They don't just know how to grow money. They know how to respect it. There's a reason I keep coming back to 7%, not because it's magical, not because it's perfect, but because it's doable. And doing it consistently is the whole game. If you can earn 7% a year, avoid blow-ups, avoid envy, avoid panic, avoid complexity, you win. You don't win because you guessed the next market move. You win because you avoided becoming your own worst enemy. And that's the hardest thing in investing, not beating the market, but not beating yourself up when you fall behind, not sabotaging your future because you feel ashamed of your past, not throwing away 20 good years of steady growth just to feel like you're catching up. Let me leave you with this contrast. The quiet rich are hard to spot. They drive old cars. They don't wear flashy watches. They don't flex. They don't teach master classes. They just keep going. The loud broke, they've got the gear, they've got the screenshots, they've got the urgency, the followers, the big talk, and then one crash later, they disappear. Which do you want to be? Because both are a choice and both are a product of small daily behaviors. That's the philosophy behind the 7% plan. It's not about being brilliant. It's about staying in the game long enough for boring to become beautiful. Now let's close this out. One last reminder. Cold, calm, and clear, so that the next time someone tries to shake your plan, you remember who you're really doing this for. There are two kinds of investors in the final chapters of life. The first kind keeps trying to make up for lost time. They chase speed. They take pride in complexity. They can't stand the idea of being average, so they overreach, overreact, and eventually get run over. The second kind, they wake up one day and say, I don't need to be brilliant, I need to be safe. They simplify, they focus, they protect, and they win. Not with flair, not with headlines, but with peace. If you're over 50, you are not too late, but you are out of second chances. That means no more gambling, no more envy, no more pretending this is someone else's responsibility. This is your game to finish, and boring is the smartest way to do it. You're not here to impress anyone. You're here to stay solvent. You're here to stay in control. You're here to stay free. That's the plan. That's the win. That's the quiet millionaire path. And if you remember nothing else from this entire video, remember this. 7% done right beats 20% done wrong every single time.